I found it is best to not look too closely when the market is correcting itself. Jumped back up yesterday by, 500 points, 600 points. Had a pretty good day there. But it gives me a little bit of indigestion to ride that roller coaster of my portfolio, so I just don't look too much. Nick Hopwood leads a team of certified financial planners at Peak Wealth, working with clients in all 50 states now, and he's gotten a lot of calls over the last couple of weeks because of corrections and how to clean things up. He's joining me now. Nick, nice to have you back on the program.
Thank you for having me, Steve.
Yeah, good to have you here. All right, so it's been a bit of a bouncy ride. So where do you want to begin?
Well, let's look at this chart that we provided with the last 15 corrections, if we can.
15 corrections. All right, there it is. Well, what's it telling me?
All right, so this is the last 15 times that the S&P 500 has dropped below 10% from the previous all-time high. And what we'll notice, going back to 2008, is that only 2 times were we lower a year later. So in other words, when the market goes down 10%, it's oftentimes a really nice buying opportunity.
So it bounces back almost every time, right? It bounces back.
Yeah, basically the common theme with the 2 times in 2008 and 2022, when it didn't bounce back, it was because there was a recession and a bear market.
Right.
And I know everyone remembers 2008, and buying the dip minus 10% was very premature, as you can see.
Sure. So let me ask you this. I mean, I'm just looking at yesterday. The Dow was up 600, basically. The NASDAQ 400, the S&P 500 by 100. I mean, that all looks pretty good. The Dow at 42, almost 42.6. I mean, we're back to pretty good place, aren't we?
Yeah, we've retraced about half of that correction, so feeling much better. But it provides us an opportunity to kind of take our temperature and say, okay, we went through this over the last month. How are we feeling today? And if our risk tolerance has changed, it's a good opportunity, to reset at these levels rather than where we were about 2 weeks ago.
Yeah, Howard Lufkin's been very much an optimist out there, the Commerce Secretary, billionaire. Of course, if I was a billionaire, I'd be optimistic all the time. But he seems pretty bullish on all of it, doesn't he?
He does. And when I was watching him for an hour and 45 minutes on Friday on the All In podcast, I thought it was well worth the watch and well worth the time. Of course, you have to watch it on 2x speed, because the guy's kind of chatty. But the bottom line is, when he talks about the tariffs and when he talks about the Doge,
yeah,
and the Doge cuts with the tariffs raising revenue, he puts together a pretty compelling case for a balanced budget over the next couple of years. And, it's been forever since we've had that. I've been talking about it on your show for 3 years now. And I never thought it would happen, but we have a chance.
Well, here's the thing. We're going to bring in $4 trillion and spend $6 trillion this year. If we can drop that down to only a trillion out of whack and then bring it back in another trillion by the following year, we can actually, like you say, balance the budget. I mean, it's not beyond reach, especially with Doge. Now, before I get too far away from the stocks, I do know that the U.S. stocks are down, but international stocks, according to what I have read and seen and been following you as well, Nick, international stocks are up. Now, why is that?
They are. Well, there's 2 reasons in my opinion. Number one, the S&P and NASDAQ have simply run away from the rest of the world over the last decade. So the U.S. is up dramatically where international has not kept up. And so this is an opportunity simply to close the gap. But also the dollar has been down. And when we're in the U.S. in dollar terms and the dollar goes down, by definition, our international investments are worth more. So it could be partly that the international stocks are going up and partly that the dollar is going down. And if that trend continues, you're going to want to definitely own international. And one theme that we see with people that are coming in as prospects at Peak, they oftentimes own no international.
I don't know if I do or don't. It's an interesting thing you pointed out to me. I don't really know. So I'm going to have to look. Look, here's the next thing. Apparently you've been out there being a keyboard warrior. You've been in a Facebook fight. Tell us about this Facebook fight you're in, Nick.
Yeah, it was a 24-hour story, Steve. We're not going to keep it into 2 days, but the Matt, the money guy, okay, you have the infographic there. You can see in the middle of the chart He has the price for for a 4-year in-state school at 109,000, and I agree with that price today. Like Michigan, Michigan State, that's kind of where you are.
Wow.
If you're in-state, but the monthly investment of $315 is simply off. The actual price needs to be the actual monthly investment for a baby today needs to be closer to $600 per month because he's simply not including inflation. If the price of 109,000, if that's the price today for college, what do you think it's going to be in 20 years? It's going to be nearly double. So it's not $315 per month, it's $600 per month. And when I just simply told him the price was $600 a month in the comments, didn't go well. There's a lot of back and forth. I want to say I was respectful, but I've been blocked and the post was deleted. So I'm just look. This is a
wait.
Great
You got canceled, Nick? You
Yeah.
got canceled.
I did. Steve, this is a great infographic. Okay, it's beautiful. It has a lot of great information, but the information is wrong. So it just goes to show you can have more followers, but be putting out bad info just because you have a pretty chart.
Right. I'm crushed on that. Anyhow, let's see. We got about a minute here. You want to get into this next deal, the gap in consumer confidence? We got about 20 seconds. Let's throw up that last graphic for Nick real quick. It's the last one we're going to get to. Go ahead.
Steve, look at this chart. Look at 2020. Actually, look at 16 when Trump was elected. Look at the red line, consumer confidence goes to the moon. And then look at 2020 with COVID, Republicans and Democrats, the chart goes down. But Republicans in 22 were lower than the lows of COVID, which is kind of silly. And right now, the Democrats are lower than the lows of COVID. So my call for everyone is to stop looking at everything through a political lens when it comes to the economy and our investments.
Here's what I want you to do. Folks, I want you to look through the lens of peakwm.com, peakwm.com/Gruber. Do it that way and get a second opinion from Nick. Nick, thank you. Great information today. Be polite on the internet, would you please?
Thank you, Steve. Well said.
peakwm.com/